Hi, this is Jim Cunningham. This is Business Succession Planning. We're going to talk about all things business succession and planning. It's a very high level, not going to get too granular, but we're going to touch on some really important concepts. This is really designed for someone who has a business, maybe a small business, could be a large business, but typically a smaller business, and they're thinking, gee, at some point I would like to retire. At some point, I would like to stop doing this. What do I do? How do I get out of this? How do I sell it? What do people do? Like, what are the big strategies? What are the big things to think about? And this is not something you want to look at if you have the LOI in hand and you're like, great, we're going to close in 60 days. And a lot of this planning that we're going to be talking about, the ship has kind of sailed on that. So these are things that you might want to be thinking about a little bit before you sign that letter of intent. So, what is business succession planning? Well, business succession planning is really a creation of a process for the future transfer of leadership, ownership, and management of a business. This could be at retirement, it could be at incapacity, it could be at death, at really of the owner or key personnel. So, something not to be not ignore is if you have a business and it's bigger than just you and a couple of people, you typically have a key person, right? And that person, what happens if that person stops working there, right? Whether it's, they voluntarily leave or they somehow stop working for whatever reason. So the idea here is you want the peaceful transfer if it's going to somebody else, or continuity of the business, right? If you lose a key person, you might be the partner who remains on. What about your partner who can no longer be in the business? So the idea is to minimize the potential disruption, because disruption really can drag down profits and frankly make you unprofitable if you're not careful. And planning helps avoid the uncertainty, preserves business value, and ensures that the business can continue to thrive after the leadership change. And if you're watching this on YouTube, I used my best AI skills to have a retiring business owner here. Guy kind of looks like Joe Biden. I don't know. But if you're just listening to this, you should check out the picture. It's kind of funny. What are some key aspects of business succession planning? Well, training and development, and this is preparing the next generation to take over, right? So if you are, whoever that is, these could be outside people, they could be inside people. You need to train your people. If you're going to be selling to an outsider, having written processes really helps with value. Companies that have written procedures and processes tend to sell at a higher multiple than those that don't. What is your exit strategy? How will the owner leave, right? Or how will a owner leave? You can either sell your interest, you can pass it to your heirs, right? Maybe your kids, or some type of internal transition with your leaders inside the organization. We're going to cover tax and legal considerations. We cover that a lot in other webinars. We're going to kind of touch on it, the importance of paying attention to it, but this really isn't a format where we're going to get too deep on the tax strategies. We do cover that in other webinars, but you should be thinking about not what your business sells for, but what you end up with in your pocket. If you have debt, you might have to pay tax on the income, right? Or the capital gain you get on your business, and then turn around and pay that debt. So you're paying that in after-tax dollars. Certainly, if you sell your business for $10 million in California, many people end up with about $5 million in their pocket for a variety of reasons, lots of taxes in California, but it's something to pay attention to. And we'll talk a little bit about wills and trust, but we'll cover buy-sell agreements and the two different buy-sell agreement strategies you can have. And then we'll talk about business valuation, the importance of it, as well as funding the transition. Cash, do you just pay somebody? Life insurance, maybe it's a loan or installment sale. So, but really the big question is then what? And that's what we're going to talk about first. So when you stop working in your business, what next? And I think for many people, this is the hardest thing to deal with, quite frankly. For a lot of people, our identity's wrapped up in our business. If you're a business owner, you understand what I'm saying. And, if you're a child of a business owner trying to get a parent, let go of the business, that can be really hard, because some people just simply don't want to let go. So if you're watching this on YouTube, please subscribe to our YouTube channel. And I'm Jim Cunningham. I'm partner at Cunningham Legal. I have 30 years experience as an attorney. We have offices throughout California. I'm a certified specialist in estate planning, trust, and probate law. I'm a real estate broker, securities and insurance licensed, and a pilot, single engine land, instrument rated. These are the lawyers in our firm. We have lots of lawyers dedicated to all things estate planning, real estate, building your family business, and transferring the wealth from one generation to the next. I'm talking. I'm a lawyer. My lips are moving. Words are coming out of my mouth. This is absolutely not legal advice. So please don't listen to this and just go out and do a bunch of stuff because you heard me talking on a YouTube video or a webinar. It's very important to get legal counsel if you're already represented. That's great. If you're not and you would like to reach out to us, we certainly help people in these areas. Our offices are located in Northern and Southern California, not too far from the bulk of the population in California. So what does the end look like? I am not talking about the end. I'm just talking about the end of the business. So, this is really something that for those of you who have worked hard your whole life, I mean, this could be the fifth business you're selling. So it's really, you've been through this before, you know what to expect. But for many of our clients, they've kind of had one business. Maybe it's just one, maybe it's a family business, maybe you've got partners, whatever it is. But what does the end look like for you? You've worked your whole life. Now what? You've got some options. Do you just close the business and fire sale the hard assets? If you run a laundromat, you're like, you know what? I don't want to sell it. I'm just going to close it and sell off the machinery. That would be a hard asset, right? Selling off the washing machines and the dryers. So that is one option, is to simply close the business. We see this with, frankly, a lot of businesses where there is no market where you can sell to an outsider or no one internally to succeed to the business. So that does happen. You can give the business away. You could give it to employees. You go, well, there's not much there. If you just take this thing off my hands, we're good to go. You can also leave it to your children or other family members. You can sell to an outsider, and we'll talk about that. You can sell to an insider, lawyers who have stuck around a little bit too long, right? Maybe their clients are leaving and the lawyer's just kind of winding things down in their 80s or 90s. That's something we see quite a bit in the legal industry. But in terms of the close the business and fire sale, we see that oftentimes in restaurants. You see a restaurant close and they're selling their equipment. So there's this sort of, what I hear from people is, oh, I'll retire in 5 years. That is not a goal. That's not a plan. I think fundamentally it's flawed thinking. So it's flawed thinking for a lot of reasons, because if you ask that person 3 years ago, when are they going to retire? They probably would have said, well, in 5 years, I'm going to retire. But 3 years later, they're not saying I'm going to retire in 2 years. This is like a 5-year thing that just keeps pushing out, further out. So if you're a spouse and you're married to somebody who is a business owner and you ask your spouse, honey, when are you going to retire? And the answer is always 5 years. I kind of take that as I'm never going to retire. Unless you have a plan, and a plan involves, how are you going to get paid? If you're just going to close it and sell the assets, that involves money. If you're going to pass it to somebody else, family members, do you want to get paid or not? But how do you get paid? Well, also, what happens if you can't work in the business? So if you're sick, right? If you're unable to show up every day and work in that business, what happens? I mean, that is part of succession planning. Like what's the game plan, right? Just before COVID, our law firm's based in California, where there are earthquakes, right? And I reached out to my leadership team, and this was maybe 3 months before COVID, 3 or 4 months before COVID hit. I said, what happens if there's an earthquake and our buildings are red tagged? What do we do? Well, the answer is we kind of go in and get our equipment and everyone goes home. Well, we took that same plan and used it for, the COVID pandemic. And so we had people go home, and we kind of really had pretty reasonably good business continuity. So, I mean, apart from what was going on in the world. What if the business value drops significantly before retirement? Now, this happens. So oftentimes a business when people want to sell their business, it's when it's hard, right? When it's good and you're making money, your profits are good, everything's humming along, no one's complaining, all the problem children have left your organization, and it's smooth sailing. That is a time many people are like, I don't want to sell it. Why would I want to sell it? Well, that's actually the best time to sell your business, when things are going good. It's when things are going bad, people are like, I don't want to take over that basket case. So that's going to hurt your sales price, and frankly, perhaps your ability to sell the business. So what are all the steps need to be taken, and who will project manage it? I'm not, this is different for every business, and someone has to project manage this. Oftentimes it's the business owner. And if it's not the business owner, there are outside, third-party consultants. Sometimes you can have this handled internally, depending on the size of your organization. There are 4 paths. Now, I didn't come up with these names. This is from Patrick Ungashik, who spoke. I'm actually in a group called Vistage, which is a CEO group. I've been in it a little over 10 years. We're going to cover what that is a little bit later in the materials. But one of our speakers spoke about business succession, and he has 4 nicknames, which I think are just great: the passer, the outie, the innie, and the squeezer. So if you don't remember anything else from this today, This tends to resonate with people. So, what is a passer? A passer is somebody who transfers the business typically to a family member. So, you are passing the business from parent to child. You're passing the business from sibling to sibling. You're doing something in the family. Parent to um, son or daughter-in-law, right? So that typically happens within the family. So they're different contexts. So this family context, and whether you pay money or not is a little bit different. I mean, it's kind of not relevant, the money side, but just think of this as passing the business from one person to another. Sometimes money's paid, sometimes it's not. Then there's the Audi, which is the transferring the business to a third party, which typically involves a sale. So when I say transfer, that's going to cover sale, exchange, all those other types of formats. But the Audi is a sale to an outside person. The innie, of course, is sale to a key employee or group of employees. That can be kind of hard. There are a lot of tax planning strategies in there. If you're selling to employees, you can look at the rules on ESOPs. That comes up quite a bit for larger businesses as a way to mitigate the tax bite. Now that adds a level of complexity. So I think many are called and few are chosen on ESOPs. A lot of people look at them. Very few pull the trigger and do it. And then there's a squeezer, which is extract as much value as possible, then just simply close the doors. And this might be the fire sale. This could be the lawyer who kind of hangs on until they're in their 80s or 90s and just doesn't want to give it up, largely because I think, at least my impression is from male lawyers, typically, not so much female lawyers, but that's your identity. I am a physician. I'm a lawyer. I'm an architect, whatever it is. A lot of times this happens in the professions. And it's part of certainly oftentimes men's identities, and it's just really hard to let go. So what is a passer? What we're talking about here is really no money. So this is where you transfer money for what we call no consideration. Consideration is a fancy legal term for basically money for something, right? If there's no money for something, there's no consideration, and that's a gift. So it's either going to be a gift or you're going to sell for what the business is worth, or somewhere in between. If your business is worth 10 million and you sell it for $1 million, that's going to be a $9 million gift to your kids. So there are some tax strategies to mitigate or minimize the wealth transfer issues when that comes up. And there are a lot of strategies you can use in transferring a family-owned business that really shouldn't be ignored, that frankly, an M&A, mergers and acquisitions lawyer may not be aware of. Your business lawyer may not be aware of this. And that's why, as you'll see, it takes a team approach of oftentimes many lawyers, and oftentimes from different law firms, because a lot of law firms are very specialty and they might just be focusing on one area of law, but you're going to need your M&A lawyer, your tax lawyer, and your corporate lawyer, your business lawyer. And sometimes those are 3 separate law firms, which sounds like, gee, Jim, you're just talking about a lot of fees. Lawyers don't charge a fee unless there's value. When you hire a lawyer and you pay the lawyer $10,000, you're going to get more than $10,000 in value. Because why would you do it? There'd be no reason to do it otherwise. So that's kind of how we view legal services. It doesn't make sense to charge a fee if no value is being delivered. If it's a transfer for consideration, if you're doing it for money, so I will, Johnny, I will give you this business, or I will transfer this business to you in exchange for money. It kind of looks more like an innie transaction, but with the overlay of the family dynamic. And so what I mean by the family dynamic is if you sell a business to a child, for example, versus a key employee, that key employee's siblings aren't going to have a say or a stake and be like, hey, well, why is this guy getting the business or gal getting the business? If it's a child and you have more than one child and you want to leave it equally to your children, which a lot of people do, that then becomes an estate planning issue. It's not just a business law issue. It's not just an M&A issue, a mergers and acquisitions issue. It then becomes an estate issue, and you need to effectively settle up. That can get really complicated. Oftentimes, if one child is working in the business and creating value and building the value of that business, and maybe the parent or parents are less involved and they're kind of more in the role of shareholders, so the value of their shares is going up through the efforts of the child, that can be a really tricky estate planning situation. And that's something where you do really need somebody who understands business, understands estate planning, and can work through the issues, whether it's one firm handling it or multiple attorneys coming together. That really does need to be nailed down, because that is a source of conflict. If you look at matters getting litigated in court, meaning people unhappy with an estate plan, many times it involves a family business, and those can be knockdown, drag out conflicts. The Audi sale, this is a sale to a third party. And typically this is going to be for top dollar. You want the best terms. If you are selling to an outside individual, and we'll cover what typically the seller wants and what the buyer wants, but if you're selling to a third party, You're looking for top dollar. You want to get every uh, ounce of value out of that business and translate that into dollars, after tax dollars in your pocket. Should you use a broker or not? I don't know. If you if it's an industry where you know all your competitors and maybe you sell to a competitor, which is a whole other topic, right? Even though you sign an NDA, non-disclosure agreement, and a non-solicitation. By the way, if you're looking at a competitor, you should have a non-disclosure and a non-solicitation. What that means is they won't solicit your key people who are involved in, like your executive team, who are involved in your business. And then you need to, do you use a broker or not? I can't say, but some people do use a business broker, some people don't. And then you've got to ready the business for sale. What do I mean by that? Well, do you want to grow the business or not? If you know you're going to exit the business in 6 years, right? Or 5 years or 3 years, what are you going to do between now and then? Do you want to increase your profits? I mean, yes, is the bottom line, right? Because the more profitable your business, you're going to get a higher price, all things equal, than a business that is not as profitable. And so many people, when they have their own business, they're running a lot of personal expenses through the business and kind of playing that game. That's not a good idea, okay? Because a lot of people won't strip out those personal expenses, apart from the ethics and the legality of it. But if people are running a lot of personal expenses through a business, it is better to have a clean profit and loss statement, a clean balance sheet. A lot of people have personal use assets, maybe a car that's in the business. We really want to rethink that, right? And if your goal is to get top dollar, you really want to have 3 or 4 or 5 years of really solid earnings, and a clean profit and loss statement and balance sheet. So that's part of growing the business. And whether to grow the business or not, I would say all things being equal, yes, because businesses that are on a growth trajectory sell at a higher multiple. What do we mean by a higher multiple? You can have a multiple of gross receipts. So if your company does 10 million a year in revenue, a 2x multiple is 20 million. You could be on a multiple of profits. Maybe it's a 6 times multiple of profits. So if your $10 million business is generating $2 million in profit, maybe it's worth 12 million. And it also depends on the industry. So you'll see multiples of earnings, which is EBITDA, which is earnings before interest, depreciation, taxes, and insurance. And you will also see a multiple of gross earnings as well. You want to keep your staff, your name, your processes intact. If you have not trademarked your name and it's important to your business, I would certainly look at that. You want to kind of tidy up those aspects those businesses tend to trade at a higher value. Also, it's important to document your processes. So having written documentation for all of your processes, again, those companies sell at a higher multiple. And you, as a seller, you may want to wish to keep your legacy, and I put that in air quotes, your legacy intact or not. So, if it's the Smith widget company and the Jones widget company buys you and scratches off Smith and put in Jones, if that really bugs you, then you may not want to sell to someone who's going to do that, right? But ultimately, when they acquire that business, it's theirs, and unless that's written into the agreement, it's not really something that is really under your control. And that being said, a lot of times when people have reached that point, it's like, I just want to be out of this and get the highest price. They can do whatever they want with the business. So a lot of people have that view. Now, the INI, I think, is one of the hardest ones. I think the INI, this is the sale to the key employees. These people may be the best and sometimes the only potential purchasers. So, if you're watching this on YouTube, we have an image of a woman selling an older lady selling her business to younger people. This can be implemented gradually over time, where ownership ownership and control is transferred to, we call them the innies, the insiders, the innies in stages. So 10% this year, 10% next year, whatever form that takes. Now that can be taken as, shares in a corporation. It could be something called phantom equity, where they're entitled to distributions as if they were an owner, but you can take that back if you want to take it back, basically, as the contract defines. And there are a lot of different approaches on this, but just understand, an inside transaction, I think, is fundamentally different than an outside transaction. And the gradual transfer can do some things. It can reassure clients, certainly if you just have a few key, really big clients. Lenders, that's another one. So a gradual transfer rather than an abrupt transfer. That lender might not be able, or might not be as willing to extend lines of credit to your business if it's a new team that really has no experience. And employees. So you want to transfer these employees in order to have a successful exit. So these are people going from employees to owners, and that tends to be more orderly than just an abrupt. You wake up on a Monday and you get your executive team together and say, okay, I'm out of here. Here's the deal. Sign today, and we're ready to go. A lot of people are going to take a little bit more time. Here's the real big problem. A lot of times the employees lack the cash or the collateral, right? They don't have the money to pay you, or they don't have the ability to get a loan because they lack, the 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 wealth, frankly, to buy you out. So what does that mean? Well, you might get paid over time, right? Okay, well, what does that mean? Well, that means if you want $1 million, they're going to have to earn four, because they got to pay 2 million on taxes, right? At least in California. So then I have 2 million left over. And then that 2 million goes to you, and you're going to have to pay in California almost 50% in tax, maybe more than 50%. So if you want $1 million after tax, they're going to have to generate four. There may be another way to do that, right? You might be able to use some type of pension plan where you're using a cash balance pension plan, or other profit sharing structure where you say, listen, once my bucket is full with my $1 million, right? Then the business is yours, right? And that may only cost them $1 million in revenue, but it may be deductible, but so maybe it's 2 million, and then they deduct the 2 million, and your 2 million now is in a retirement account, so you have to pay 50% tax, but they only have to come up with 2 million versus coming up with the 4, right? So these are the tax strategies, and if you didn't quite get that, the idea here is that you would be effectively purchasing the business in pre-tax dollars, not after-tax dollars. So it really is important how the deal is structured, and that's something that we work on with our clients, is structuring these deals. This should be done, frankly, years in advance. And if you have this imminent need, maybe you have a health crisis or a health issue, it's a good idea to have done that planning. But if you don't have time to do the planning, it may mean that you're not selling to an innie, or you're not going to get the terms you want. You may have to sell to an outie, or you may be a squeezer, right? Which means you just squeeze every dollar from the business until it closes. These tend to be profitable businesses with significant cash flow and maybe no buyers in your industry. So what am I talking about? Competitors have a low barrier to entry. You see this a lot with lawyers, frankly, and in what we've done in our firm is we have, as lawyers sort of raise their hand and retire, many times they transition their practice to our firm, and there really aren't a lot of buyers that are doing that, right? So law is one of those where there aren't many buyers. CPA firms, if you go on a business listing, you go to these business brokers on their website, they've got a lot of CPA firms listed for sale. And I don't know if there are no buyers, but there are a lot for sale, right? But there may not be as many buyers available to buy those. So a lot of times there isn't somebody inside the practice who can take over. And really, the smaller the business, the more likely it is to be a squeezer. So this is where you might have the older lawyer in their office in their 80s, just kind of winding things down, and their practice is getting smaller and smaller. And then one day they just close the doors. So a little bit of a downer on that one, but sometimes it's the nature of the industry. So there really are no buyers. So what is business succession planning? What is it? So it is a strategy for identifying and developing future leaders at your company or outside your company. This is a focus on people. So I firmly believe that business succession planning is not about signing a bunch of documents or writing up, getting some forms and filling them out and putting them in the, in your scan and sitting there on your computer. We're talking about people. Now, this is at the top, and I would say all major roles in your company. So at all major levels. So depending on how many people are in your organization, what your organization chart looks like, I would say that the key people, you really need to pay attention to that. And are these people going to stay? Are they functioning at their highest and best use? This helps the business itself prepare for all contingencies by preparing high potential workers for advancement. So I firmly believe that the who decisions are the most important in life. And I think as I get older, the more this resonates with me. Who you marry, pretty important decision, right? Who your parents are, you don't have a lot of control over that. Who were you born to? That's a pretty important decision. Having been born in North America in the 20th century is kind of like winning the genetic lottery. Okay. And that was totally out of my control. So the who decisions in life, pay attention, your key people, these are oftentimes extremely hard to replace. And they might be irreplaceable. right? And these might be the people who take over your business. So really, I would say focus on the people, and have that lead. So let's talk about a little nitty gritty thing, a buy sell agreement. Now you may have heard of this. So this is kind of buy sell agreements 101. It's an agreement that stipulates or says how a partner share of a business may be transferred in the event of a partner's death or departure. And the legal term for this is separation. So when that partner or owner separates from the business, right? That's when this agreement kicks in. So the idea is here, could you have a buy sell agreement with an outside person? Yes. But for our purposes here, this is going to be a couple of people that own the business. Now, you might do this on an innie, right? You might bring on an inside transaction, you might bring a key employee in as to 10%, right? We see that a lot, whether it's phantom equity or actual equity, whatever it is. But the buy sell agreement lays out a framework for what happens when the partner separates or is no longer working in the organization through death or disability or voluntary departure. And this can, but does not always have to specify a method for valuation. So sometimes there's a fixed dollar amount, and I think you can understand that probably will not be the actual value of the business, right? When the event occurs, there might be a formula for determining the value of the practice. Some buy sell agreements, they say, hey, last man or last woman standing gets everything. So if they're two business partners and one dies or one leaves, the other one just kind of gets it. I mean, that could be a perfectly valid buy sell agreement. So this involves two basic paths. One is what is called a cross purchase agreement, and this allows the remaining owner or owners to buy out the interests of a deceased or a selling owner. So this is where you have two owners, and we have an example on this. One is no longer working at the business, and the other one buys that person's shares in the company. A redemption agreement requires the business entity to buy the interest from the deceased or the selling owner. So this is where you have one person leave. Well, as you'll see in our example, there's 10 people in the company, right? 10 shareholders, one shareholder leaves, the company buys that exiting owner's shares or right interest in the company. And then that's essentially split up between the remaining owners. So they collectively are buying out that one person. Wait and see allows some flexibility. It allows people to decide at the time of the separation whether it's the business or the remaining owners that buy out. We don't see that a whole lot, but it can be a combination of both, quite frankly. And this is often funded with life insurance. So a little bit of both, but typically it's going to be a cross purchase or a redemption. Those are the two main ones we see. The wait and see can just kind of be more stuff to deal with partners, frankly, and can be a little bit tougher to get agreement on. So let's talk about death of a business partner, what to do if there is a plan. So Abel and Baker are business partners in FunCorp, which distributes party supplies nationwide. Abel and Baker are 50-50 partners, and the business is valued at $20 million. Abel and Baker create a cross-purchase buy-sell agreement, and this is funded with a $10 million policy of life insurance on Abel and a $10 million policy of life insurance on Baker. If Abel dies, Baker is the beneficiary of Abel's $10 million life policy. Now, this is very interesting because if Abel is married, Abel's spouse is going to say, how come I don't get that 10 million, right? So, but Baker's contractually obligated to pay 10 million to Abel's living trust, right? So Abel does get the 10 million, Baker gets the business, okay? So that's a requirement. So Baker gets the 10 million and Baker is required to buy the Abel's half of the business. This is used in smaller businesses where each owner can buy out the other one. It doesn't have to be funded with life insurance, but oftentimes people don't have 10 million to buy somebody out. And that's a fairly large number. You could take off a zero. Let's say the business is worth 2 million. Baker may not have $1 million to buy out Abel. What if they just agree that they'll each, even though it's a $20 million company, and if one partner dies, they get to buy out the other half for $1 million? That's perfectly valid, right? This is a free country. You have the freedom to contract however you want. If you're married, you need spousal consent on that. And that's a very important aspect to this, is getting spousal consent. So if Abel's spouse isn't on board, you're going to have some issues, right? And so this is where this is not easy, okay? It can get really messy. So what about, what do you do if there is a plan? Let's use another example. So there is a buy-sell agreement in place. By the way, if there is not a buy-sell agreement, it's a cluster, okay? It's terrible, right? You need to have some form of a plan, something written down, because if there is no plan, oftentimes a probate court gets involved, and that's the last thing you want, okay? So the example is Charlie, Delta, Echo, Foxtrot, Golf Hotel, India, Juliet, Kilo, and Mike. That is C through M, 10 shareholders in Gem Corp, a manufacturer of jewelry. Business is valued at $100 million. A redemption buy-sell agreement is created. Charlie dies. His $10 million stake in Gem Corp is purchased by Gem Corp. The company buys it, and Charlie's living trust received $10 million. Gem Corp is contractually obligated to pay that $10 million to Charlie's living trust, and the business carries on. So this is a company that has the resources to write a check for 1/10 of the value of the company. This is often simpler to deal with than a cross purchase. When you have a lot of people, it's just easier for the company to buy it out. So I would say on a very high level, if you have a lot of owners, you're going to see the redemption. If you have 2 owners, you're going to see cross purchase. 2, 3, or 4 owners, you'll see a cross purchase. By the way, if there are 4 owners and one dies, that agreement could say that just one of the other people buys the shares, right? Not all 3. So again, this depends on what the business owners want to do. And this is why it's really important to engage appropriate legal counsel. This is something that we do at our firm, is we help business owners with succession planning. So I would say what you don't want to do is you do not want to start the planning when your letter of intent arrives. That is like really late, okay? It's better to have a plan in place to increase the value of your company before its sale. And let's look at some best practices on maximizing values, right? I would say one of the biggest mistakes we see is not engaging your A team early on. Now, we cover this in other webinars. What is an A team? It's like the A team from the 80s, Mr. T, and right, the guy with the cigar, George Papard. I can't remember his character's name. Not getting that team, not that team, but your attorney, your CPA, your financial advisor, your corporate attorney, your M&A attorney, your mergers and acquisition attorney, and other affiliated professionals. You know, if you own real estate, you might need a real estate broker in there, appraisers, regulatory advisors, right? You need all this stuff, and all these people need to work as a team. And it's much better to do this before your LOI. I do want to say one thing, another mistake that I see in business succession planning is, as a general rule, capital assets like real estate should be in structures that are not corporations. That's either a partnership, so it's either an LLC taxed as a partnership or an LLC taxed as a disregarded entity. So one of the things we cover in our other videos is a limited liability company is a very flexible structure. It can be what is called the disregarded entity. And what that means is you file a state return if you're in California, but no federal return. You report all that activity on your own 1040. That's a disregarded entity. So for federal purposes, it is disregarded. For state purposes, it's regarded. Okay, the state's paying attention to it, not the federal government. So an LLC, typically a single member LLC, or if you're in California, a married couple owning it as community property, that can be a disregarded entity, does not file the tax return. An LLC can also choose to be taxed as a partnership. So what that means is when you have an asset such as a rental property, and then you own that as community property, or you just own it and it's in your estate, and then you die, you get an adjusted cost basis on that asset, meaning you can sell that asset free of capital gains tax without doing any other, any other transactions. When it's in a corporation, you do not get an adjusted cost basis on the asset itself. So if you have an S corp, if you have real estate in an S corp, to me, that's a red flag. That's something you want to pay attention to with your real estate planning attorney, your real estate and estate planning attorney, as well as your CPA. And again, if you don't have an attorney for that, that's something we can help you with. We can certainly help you find a CPA. But having your real property in a corporation, typically a really bad idea. It can be very difficult to get it out absent somebody dying. So again, just something that you need to know, because if the real estate's going to be sold with the business, you might be better off having that in an entity taxed as a partnership. How to maximize value. What do we do? 5 big ways to maximize value. I would say number 1 is consider joining a peer group. And I mentioned earlier that I'm in Vistage. Vistage is I believe it's the world's largest CEO group. They're all over the world. And we meet monthly. We take a day out of our month and we meet at 7:30 and we end, at 3 or 4. And we typically have a speaker who talks about, the part of this innie outie passer squeezer I saw from one of our speakers. So a little nugget, and that was almost 10 years ago. So a peer group. Why a peer group? Number 1, you're going to learn. It's almost like getting a super MBA. Secondly, you're going to have people to talk to other than your spouse. Okay. So for many of you who are watching this or listening to it, your spouse, you come home from work and you're talking to your plus one and he or she's thinking, I'm really would just like to talk to you about something else other than all the stuff that's going on in your work. And that's something that you can do with the Vistage group. And then we also meet one-on-one with our our peer group leader for a couple hours during the month. YPO is Young Presidents organization, and I believe you have to be under 50 for that. Maybe it's under 40. I think it's under 50. That's just kind of a competitor out there. And there are some others out there, but that's a peer group. Number two is pay attention to macroeconomic factors. What am I talking about? Well, I'm talking about business cycle, right? So macroeconomic factors, when the economy is chugging up, coming out of a recession, certain industries do better, certain industries don't do better. As the economy is declining, again, everyone has their own industry cycle, and you need to pay attention to what your industry is and the macroeconomic factors, right? So when 2008, that was right after the baby boomers hit their peak spending. So that is one big reason that we had a drawdown in the economy in 2008 is baby boomers hit their peak spending. Now, what they're talking about is another one coming like in 2029, where these are macroeconomic factors. You're going to have a lot of people leaving the workforce, and there's a concern that the economy will be kind of going into recession, if not an outright depression in 2029 or 2030. So that's what I'm talking about, macroeconomic factors. Pay attention to key inputs. We'll talk about what that is. Basic business hygiene. What's that? It's like washing your hands before you eat. We're going to talk about what that is and how to know the difference between a good and a bad deal. Real high level, good and a bad deal right out of the gate. If somebody says, this is what I'd like to do, you can say, that's a bad deal. And I don't think we should talk anymore. So should you get a coach, a consultant, or a peer group? Those are kind of the three. So if you say, gee, I'd like to sell my business, I don't even know where to start. How do I, maybe documenting the processes. Okay, I can figure that out. But how do I train the next level of leadership? What should I be doing? How can I learn how to do this? Well, a coach is somebody who's kind of one-on-one talking typically to the principal or the principals. Should you get a generalist, right? Maybe some generally, I know about business, or if you're a dry cleaner, should you get someone specifically, I coach owners of dry cleaners who want to sell in the next 8 years. And that's what I do. This is not me. I'm just pretending, right? That may be a good person to go to if it's particular niche in your industry, or a consultant, right? A consultant is somebody who might work within your organization and help develop processes or procedures rather than the coach, which is like, okay, what did you do? The consultant's kind of down in the weeds, helping out. Should you get a technician? What does that mean? You may have a specific need in your company that requires fixing. It may be somebody in the founder when they got up on the ladder and kind of rearrange the kitchen in McDonald's. You might need somebody like that who kind of understands how to make hamburgers, and which is probably a bad example because it's not that hard to figure out. But where I'm going with this is you may need someone who has a deep industry experience in what you're doing, and you might need that in order to increase the value of your company, or just like-minded people. And that's really the Vistage. Typically, the Vistage is going to be a variety of people in industries, and it's going to be more bouncing ideas of, okay, I've got this issue with my leadership team. I've got this person who's really not working out. How have you guys handled this in the past? So it tends to be more general. Coaches, they can be part of your network. They can be your old boss, a family member, or a friend of a friend. And the thing about a coach is they'll provide unbiased feedback to your business operations. Like, hey, why are you doing that? That sounds like a really dumb idea. And identify blind spots. Have you thought about this? Maybe look at this other thing. And the nice thing about a coach is they're when you are doing your thing at work, there's nobody from the outside saying, hey, I saw you do this, and you might think about doing it a different way, because typically your employees aren't going to tell you that, right? So you need an outside person. And LinkedIn is the number one social media platform for networking professionals. You might find a coach on LinkedIn. I don't know. The consultants, the technicians, Navix is Patrick Ungashik's company. They've developed a logical and methodical process. They're not a competitor to our law firm. They do really good service. They guide you through a multi-year process. They help you navigate all the stuff you have to do to get to the sale of your business. and ideally at a great price. And I think it should be very specific to a particular area, meaning what is it that you're doing, right? That requires a different approach. If you're a manufacturer of widgets versus a professional services organization, you're going to have a different process. You're going to have a different structure. You will have different multiples, different valuations. So Navix is one of the consultants who can guide you through a multi-year process versus the coach who's kind of one-on-one giving you input. And then the peer group, what I like about the peer group is I hear perspectives and experiences that I could never cook up on my own, right? It's like, I could never even thought of that. That is like the wackiest thing I've heard. And then sure enough, it happens in my company a year later and you go, oh, that happened to this other person. And so you got a little bit of a head start on it. The industry agnostic ones are the Vistage, the CEO Alliance is another one. Industry specific, you might go to construction, collision repair, sales, whatever your organization is. But the peer groups are in two flavors, sort of general or industry agnostic, and then in a particular industry. Statistically, companies grow at 2.2x faster than non-Vistage companies and have a higher rate of profitability. Sometimes it's due to what people learn in an environment like Vistage. It forces accountability. So if you say, hey, I'm going to do this, you've got a team of people other than your spouse, right? And the leadership, if you're a solo owner, this is especially hard. The leadership team in your company might just not understand, right? They certainly don't have the moral hazard, right? If you come up short $100,000 in a given month, you're writing a check to keep that business going. That's not necessarily what those employees are used to, certainly not used to doing. So definitely worth checking it out even if you're not thinking about selling. By the way, I think you should always run your business as if you're going to sell it. That makes sense, right? Macroeconomic factors, these should not be ignored. So what do? Do you just watch the news? Do you watch Google? There's a lot of clickbaity news stuff out there. You go, oh, the economy is going to go down. Is the stock market going to go in the tank? Buy gold, buy crypto, whatever. But there are some really key macroeconomic trends. So we live in a consumer-centric economy, right? And whether you're a business to business or a business to consumer, 70% of the economy is consumer driven, but not everyone has the same business cycle. So what do I mean by that? There's, when things are going up, things are kind of plateauing, things are starting to go down, and then it's the dip just before it goes up. Different industries are in different cycles in a given economy. So it's very important to understand that. We have used the Beaulieu brothers. Beaulieu is I guess the French way of saying it, but they call it Beaulieu brothers. They're an economic group out of Canada, but it's important to pay attention to economist and economic. These are the macroeconomic factors. And one thing I learned in a recent video watching them is specifically if you're in California, since I think 2019 has had a declining population. And now it may have started coming back up post-COVID, but California really depends on a lot of foreign immigration, which kind of shut down for a few years during COVID. A lot of people left California. So California's population declined by, I think, 0.1% or something, maybe 1%. And the other thing is California is aging. So the available labor pool is shrinking. And this is a problem in California is there are fewer available workers. That is what an example of a macroeconomic factor, right? That's more of a demographic factor. But again, this is part of really paying attention to this. So you might think, gee, why are my labor costs going up? Why is it so hard to hire somebody? It's because the available labor pool is shrinking and the California economy continues to grow. So again, so you may lead, you may lag, you may be at the top of consumer trends, but understanding how your business relates to macroeconomic trends, you should understand it and follow it, and where the economy is going and how does your company fit into the overall cycle. So if you know that things aren't good now, but based upon the economy doing whatever it's doing 12 months ago, you might be lagging. So you might, days are dark today, but you might have better days a few months from now. It's good to be armed with that knowledge because that can help you build the overall value of your business. Paying attention to pay attention to miles driven in economic reports and forecasts. So if you're collision repair and miles driven in your neck of the woods is going down, there are going to be fewer accidents. It's not rocket science, right? And so you need to be prepared for that. If miles driven are going up, then there are going to be more collisions. So that's something you might want to look at expanding, right? So just something to think about. What are inputs as a business owner? What do I mean by inputs? Well, every business seeks to create value. Businesses take in things, add value, and have output, right? Depending on the inputs, you need to pay attention to creating the value. So what do I mean? Very simply, you take in, and we'll have an example on the next slide, you take in wood pulp and make paper, right? Well, you're adding value by taking that wood pulp in, you're doing some stuff, and then you're selling it as paper. So that difference between the value is where your profit is. If everyone starts doing it and they drive up the price of wood pulp, right? You're not going to be able to add as much value. You're not going to be able to capture as much profit. So you really need to pay attention to the inputs that are coming in and the value that's being captured. What you can sell for, what is called willingness to pay. If you have a lot of irrational competitors out there who are driving up the price, right? It's going to be, or driving prices down, sales prices down, and maybe costs up. It's going to be harder to capture value. It's going to be harder to make money, right? And so one of the examples we have here is from Jim Collins' Good to Great, and this is Kimberly Clark closing the mills. They were a huge paper company. Well, years and years ago, the company sold all their paper mills, despite it being core to their business. They were a paper company, right? They were manufacturing paper. They shifted their focus to consumer products, Kleenex, right? That was the big one. This was risky, very controversial at the time, but ultimately led to long-term success. And leaders have to be willing to let go of legacy parts of the business to pursue greatness. And that's really the takeaway from the book. So there might be a legacy part of your business that's maybe 20% that, oh, we've always done it. It's okay. I'm giving you permission. It's okay to look at that and think, should we continue doing that or not? Does it continue to make sense to do that? This takes discipline. It takes a focused choice that drives this transformation. So it's very important. And if you're a business owner, I know there's something in your business where you go, we're just not making as much money on that anymore. Something's going on. It's hard to discern. Maybe sales are down, or just the cost is going up, or competitors are coming in. Maybe it's time to move to something else. Maybe let go of that legacy product. And we're going to end with, how do you know the difference between a good deal and a terrible deal, a bad deal? Well, here's what deals look like from the seller's standpoint. So this is you. If you want to sell your business, you want a big check, not like the big one with the lotto winners get, but it's a normal check or a wire transfer with a lot of zeros. Okay. No contingencies, right? You give us the keys to the business. Here's a bunch of money. No earnout, meaning you don't have to stick around. The business doesn't have to perform. Here's your money. And you get to go home and do something else. No strings attached and a great price. That doesn't exist often in the real world. If there are no strings attached, you're going to pay for that as a seller. You're probably going to get less of a price. And then the buyer has the opposite perspective. They want to make the seller stick around and work slavishly for low wages and with nothing down, right? And pay over time and with little risk to the buyer. So the buyer wants to minimize downside risks. Those are the two goalposts, and the deal is going to be done somewhere in between there. So it is not uncommon for the seller to sell and there be what is called a holdback. When a holdback means is, buyer says, I'll buy your business for 10 million. Here's a check for 5 million. And we're over the next 3 years, if this business hits these benchmarks, I'll give you the other 5 million. If it comes up short, you're going to get less. If it exceeds that, you might get more. But that's typically what we're seeing in a lot of deals. There are some deals where, you might be talking, if you're on the buyer side, the business broker says, well, the seller has a great business. The numbers are great. They want top dollar and they don't want to have to deal with anything. Well, the reality is the seller's going to pay for that. It's going to be, it's more risk on the buyer. And so the risk reward premium is certainly at play. So that brings us to the end of our materials. I hope this was helpful. If you're watching this on YouTube, please subscribe to our YouTube channel, and we will open it up for questions. So if you're watching this on YouTube, just keep watching, because magically another video is going to roll right after this one. Thank you for joining us.